Thank you for coming back for section 19, where we will wrap up the category of KPIs for global purchasing specific to finance and accounting. Continuing on, the suite of finance and accounting KPIs for purchasing should include purchasing-related transportation cost, but itemized by mode of transport. We wouldn't consider this a gray area, but we are starting to get into a little bit of the logistics side of KPIs. But purchasing very much depends upon transportation for both operational purposes, but also for the calculation of landed cost. While recognizing that transportation costs are a little bit more logistically oriented, we will include them in purchasing KPIs. There always could be a little bit of overlapping. But purchasing-related transportation cost, as we said, itemized by mode of transport. Air freight, ocean freight, truck or rail for North American imports from Canada or Mexico. We want to be able to isolate by mode of transport, especially air freight, because that's the most expensive mode of transport. Another one, customs duties paid on purchased items by month, quarter, and year. Purchasing people, and definitely sourcing people, need to know the customs duties on specific items coming out of specific countries. And when working with customs brokers that have some decent reporting capabilities, they can break out per item customs duties fairly easily. Same can be said for merchandise processing fees as well as harbor maintenance fees. Those are a little bit more difficult to isolate by items because MPF and HMF are on overall customs entries, entered value as it's called, but still important to measure as a KPI nonetheless. Let's talk a little bit about the impact of air versus ocean freight, looking at it from the purchasing perspective. Whenever possible, most companies that import from countries outside of North America prefer to use ocean freight as their primary mode of transport. Due primarily to cost savings derived from economies of scale, you can get a lot in an ocean container for a very reasonable price. Ocean freight is typically at least 4 to 5 times less expensive than air freight, depending on the airport of origin, airport of destination, time of year, etc. Second paragraph. Unfortunately, companies that employ ocean freight as the main mode of transport are inevitably faced with the need to import goods via air. Due to issues as diverse as underestimated product demand, end-of-month quarter revenue recognition requirements, meaning we have to get stuff in quickly and sell it so we can get it on the books as a sale, product quality issues, or a vendor's late delivery, all things we've spoken of before, the need for air freight not only has to be acknowledged, it has to be measured as well. There's a clear link between the need for air freight versus ocean freight in purchasing, depending upon the reason behind the need for air freight. If purchasing is constantly asking for air freight from the logistics department because they're placing orders late, that's a purchasing thing that once again trickles into another functional area. Third paragraph. Needless to say, out-of-control air freight shipments will blow up a product's landed cost calculation while far exceeding budgeted allowances. As such, an item's gross profit is not only negatively impacted, the increased expense of air transport depletes an importer's cash flow. That just means that we're spending a lot of money on air freight that we could have been spending on something else. Given these negatives, air freight must be measured on a periodic as well as on a product and vendor-specific level. KPIs of this nature not only account for expenses, that financial side of things, but can also help to expose the root cause of air freight shipments in the first place. In turn, this information can lead to continuous improvement initiatives that drive down the need for air freight in the future. An important point to be made here. Financial KPIs in and of themselves are very important. But if we look deeper into the reason behind financial KPIs, why air freight is high, things of that nature, we can uncover root cause that is well outside of the financial component. Let's say to a certain extent that financial KPIs are important in and of themselves, but they are a symptom, if they're negative KPIs, of an underlying illness. It's up to us to uncover that underlying illness. We see that here in the case of air freight. What is the underlying cause for air freight? Moving on, other finance and accounting KPIs, more internally oriented to the purchasing department itself, which definitely has to be measured. Total payroll of the purchasing department. How much we spend on the purchase of imported items is one thing. The payroll that underlies the people working in purchasing has to be measured too. What's the average cost per purchasing employee? Another one to look at, what's the average cost per purchase order? Or better yet, as we'll see moving forward, how many purchase orders do we place in the first place in the course of a year? Accounts payable. That sounds a little bit odd, but when we place purchase orders on vendors, the unfortunate reality is that we have to pay for that stuff at some point in time. So AP, accounts payable, which is clearly an accounting issue, has to be visible to the purchasing department. Another is days payable outstanding, which is just a calculation that tells us how long does it take us on average to pay our vendors. Is it 30 days? Is it 60 days? Is it even longer? Purchasing needs to know that too, because vendors have a tendency to get a little upset when they're not getting paid on time, and they might express that frustration by saying, we're not shipping you any more merchandise. Another example of integration, this time with accounting and purchasing. A couple more to talk about. What about cost savings, just in general in the purchasing department, by type and amount? Renegotiation of a unit cost for an item coming out of Cambodia. Is there a cost savings there? Maybe there is a cost savings associated with the process through which we place purchase orders. We made it more economical to do. By month, quarter, and year, in a purchasing environment, cost savings of all types have to be measured. Total inventory value. Once again, we in purchasing, especially when dealing with a finished goods environment, we're the ones purchasing the inventory. We need to know its value. We need to know how many times that inventory is turned in a year, inventory turnover. That's a clear measure, in part, of how effective purchasing is being in its procurement of finished goods. Days of inventory, just another way of expressing inventory turnover, really, but tells us how many days can go by before we run out of inventory. The higher the number, the more inventory we hold, expressed in days. And any inventory carrying costs as well. Inventory carrying cost, definitely an inventory management responsibility, definitely a distribution responsibility. But to repeat, it's purchasing that is acquiring the inventory in the first place. So if carrying costs are way out of control, maybe one of the solutions is to not buy as much inventory. That's just one example, but to say again, an example of integration between purchasing, inventory management, and U.S. distribution in the end. Let's talk a little bit more about the need for integration and collaboration between purchasing and inventory management through a supply chain perspective. For an importer of finished goods, it is the purchasing department that drives inventory levels across the organization. We just said that. Because there are no raw materials or work in process in a finished goods model, the quantities of goods that purchasing acquires, along with how much the sales department can sell and get rid of some of this stuff, is the driving force behind the dollar value of inventories, unequivocally. Of course, the quantities of merchandise that purchasing acquires are influenced by factors that include, broken record alert here, sales forecasts, customer orders, back orders, seasonality, quantity discounts from vendors, minimum order quantities, and safety stock requirements. With that said, last sentence in the second paragraph, given all of these factors and the large amounts of money a company can invest in inventories, it is essential to track inventory values throughout the year. Last paragraph, and we mentioned this briefly a moment ago, while the math is beyond the scope of this module, two key metrics that companies use to track inventory are inventory turnover and days of inventory. As we briefly described, the inventory turnover metric is helpful because it reveals how many times during the course of a year it is acquiring and selling inventory. The higher the number, the better the inventory performance. DOI is also good in that it tells a company how long it has before it runs out of inventory. In both instances, importers need to use these figures to drive future purchases. Buy more, buy less, or stay on the same path. Purchasing and inventory management must be aligned in an import organization. That's the theme we're driving home here. Last slide in this section, we'll wrap it up fairly quickly. The suite of finance and accounting KPIs for purchasing should also include any value of write-downs of obsolete merchandise. Purchasing goes out and buys finished goods. For whatever reason, we can't sell them. They become obsolete. No one wants them anymore. What's the value of the write-down? That has to be a KPI. What's a write-down? It's a value that is written off from inventory and ultimately taken as a loss on the income statement. It should be clear that the write-down KPI, the value of write-down, should tell us what we bought too much of and to apply that knowledge in the future. Any dollar value of damaged merchandise, again, a little bit of a crossover into the logistics space, but must be measured as well. And then, of course, dollar value of defective merchandise. Stuff that came off the line defective was maybe captured during a quality control check at origin or maybe got all the way to us in the United States. Either way, we need to know the dollar value of defective merchandise so we can go back to specific vendors that are making these particular items and address the quality issue. A high dollar value of defective merchandise is a symptom of an underlying illness. We use that KPI to dig deeper and solve the real problem. We're good for finance and accounting KPIs. Upon our return, we'll talk about more KPIs for global purchasing, internal operations, internal to the purchasing department of our import company.